So, if you work in the United States, there is literally a 1 in 6 chance that a company called Automatic Data Processing ADP is the one generating your payslip.
Yeah, 1 in 6. It's massive.
Right. You probably just, see their logo at the top of a PDF every 2 weeks and then never think about them again.
Most people don't.
But today, we're doing a deep dive into how this supposedly boring human resources software is actually secretly operating as a massive $48 billion shadow bank.
It is wild when you actually look under the hood.
It really is. We are looking at this comprehensive 2026 financial valuation research report on ADP. And I mean, the deeper you look, the more this looks like one of the most lucrative, perfectly optimized financial machines in the entire global economy. But before we get into the hidden machinery of your paycheck, I need to share this. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join deepvalues.ai app. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play.
And of course, the legal side of things. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.
Awesome. So let's look at the sheer scale of what we are dealing with here, because ADP manages HR data for over 42 million individual workers globally.
42 million.
Yeah. And in their fiscal year 2025, they hit $20.56 billion in total revenues. They are servicing like over 1.1 million corporate clients across 140 countries.
Right. And I mean, when you are operating at that level, you aren't just selling a software product anymore. You're basically the plumbing of the global economy.
That plumbing analogy is perfect, actually, because, you only ever notice the plumbing when it breaks.
Exactly. And that is the perfect way to understand their primary economic moat. Because most people think of software as something you can just easily swap out.
Like if I don't like Microsoft Word, I just switch to Google Docs.
Right. But enterprise payroll is fundamentally different. ADP's revenue is primarily split into two segments.
Yeah.
And the first is employer services.
Which is their main software thing.
Yeah, that makes up about 67.5% of their revenue. So this includes their high-margin, cloud-based software for payroll, human capital management, and, compliance.
And when a company installs that software, it gets deeply, deeply embedded into, like, every single facet of their operation.
Oh, absolutely.
I was reading the report, and the operational risk of trying to rip that out is just terrifying for a CEO. I mean, if an email migration fails, people are annoyed.
Sure.
But if a payroll migration fails, people literally can't pay their rent. Employee morale collapses instantly, and government regulators start handing out massive fines.
Yeah, the switching costs are just astronomically high.
Hmm.
I mean, migrating an enterprise payroll system for a multinational corporation with tens of thousands of employees, that's a multi-year, highly complex project.
It's fraught with danger. Which actually brings me to something that always kind of bugged me about these legacy tech companies.
What's that?
Well, we live in this era of incredibly slick, modern HR startups, right? You have companies like Workday, Gusto, Rippling, and they offer these beautiful, intuitive user interface.
Oh, totally. The UI is gorgeous on that.
Right. And ADP was founded back in 1949. You would think they'd be just hemorrhaging clients to the new kids on the block, yet their client revenue retention rate sits at an unbelievable 92.1%.
Yeah, 92% is insane for software.
It is. So I have to wonder, is it just like fear of migration keeping people there, or is there an actual structural advantage?
I mean, fear plays a big role, obviously.
Right.
But the real structural advantage is their data density.
Data density.
Yeah, because ADP processes payroll for a sixth of the U.S. workforce. They aren't just looking at isolated companies. They're looking at the entire macroeconomic landscape in real time.
Oh, wow. I didn't think about that.
Right. Their data is so vast and so accurate that it literally powers national employment reports.
Wait, really? The government data?
Yeah, exactly. So they can offer a Fortune 500 company analytics and benchmarking showing them exactly how their compensation and turnover compares to the broader market, literally down to specific zip codes.
And a shiny new startup just doesn't have that historical footprint.
Exactly. They simply can't provide that.
Okay, so they have this incredibly sticky software business, protected by fear of migration and massive data advantages. But the second segment of their revenue, the other 32.5%, is what really made me do a double take in the research.
Ah, yes, the PEO services.
Right, professional employer organization. From what I understand, under this model, ADP doesn't just sell you software, they actually become the employer of your staff on paper.
Yeah, it's called a co-employment model, and it is a massive operation.
How does that even work?
Well, imagine you run a mid-sized design agency, right? You want to focus on design. You don't want to spend your time negotiating workers' compensation insurance or managing health benefits or dealing with like complex labor compliance across 50 different states.
Right, that sounds like a nightmare.
So under the PEO model, ADP steps in and essentially pools your employees with hundreds of thousands of others. This gives small and mid-sized businesses access to Fortune 500 level benefits because of ADP's sheer negotiating power.
But there is a massive accounting quirk here, isn't there? Like, you have to watch out for this if you're looking at their income statement.
Oh, definitely. You mean the pass-through costs.
Yes. Because ADP acts as the employer on paper, they have to count the actual wages and the payroll taxes of all those co-employed workers as their own revenue.
Yep.
And then they immediately record them as expenses. I mean, we are talking about over $60 billion over a 9-month period that just passes straight through their books.
It's 60 billion,
Yeah.
just in and out.
It drastically inflates their top-line revenue number, but it generates literally zero profit margin.
Right, those are known as zero-margin pass-through costs. It makes the company look much larger on a revenue basis than it actually is in terms of true profitability.
So to understand how they actually make their real money, we have to look past the software subscriptions entirely.
We do. And plus the PEO model, too.
Which brings us to the hidden genius of the whole operation. Because, if ADP just collected fees for their services, they'd be a solid
It's a
business.
very solid business, yeah.
But they are secretly operating what is essentially a shadow bank, and they do it through something called the float.
The float is everything. It is the true engine of ADP. Let's walk through the actual mechanics of a payroll cycle to explain it.
Okay, lay it out for me.
So when a company needs to pay its employees on a Friday, they don't just wire the money to ADP on Friday morning. ADP requires the employer to send the payroll and tax funds days in advance to ensure everything clears and the payments are securely routed.
Okay, so it's like a Tuesday, and millions of businesses across the globe wire their entire payroll for the week directly into ADP's accounts.
Exactly.
But the employees won't actually get their direct deposits until Friday, and the various tax authorities might not get their cut for several more days or even weeks.
Right. So for that window of time, ADP is just sitting on a mountain of cash that doesn't actually belong to them.
And they don't just let that cash sit idle in a checking account, do they?
Oh, absolutely not. They invest it. The recent quarterly data from the report shows that ADP's average daily balance of these client funds is a staggering $48.3 billion.
$48 billion, that is just sitting there.
Yeah, and they take that zero-cost capital and deploy it into high-grade fixed-income securities.
Man, here's where it gets really interesting to me. It's like a toll booth operator on a major highway.
How do you mean?
Well, imagine if the operator gets to collect millions of dollars in tolls all week, but they only have to hand the actual cash over to the state government at the end of the month.
I see.
In the meantime, they get to put all that state money into an interest-bearing account and keep 100% of the interest for themselves. I mean, they aren't taking wild risks. They're buying incredibly safe government bonds and corporate debt. But because the pool of money is so gigantic, their returns are massive.
That's a great analogy. And looking at the third quarter of fiscal 2026, their average interest yield on that $48 billion float reached 3.3%.
Which doesn't sound like a lot on paper.
No, 3.3% seems small. But that generated $404 million in interest revenue for ADP in a single quarter.
Wow.
And if we look at the full fiscal year 2025, the float generated $1.19 billion in pure interest revenue.
And the profit margin on that $1.19 billion has to be practically 100%, right?
Basically, yeah.
Because it doesn't cost them anything to hold the money. It's essentially a free subsidy for their core software business.
It flows almost straight to the bottom line, which is exactly why ADP is so unique. Most software companies are highly sensitive to their own internal sales cycles and, subscription renewals.
Sure.
ADP has all of that, obviously. But they also have this macroeconomic sensitivity baked right into their model. They care deeply about what the Federal Reserve is doing.
Right, because if you are earning interest on $48 billion, an interest rate hike from the Fed is like manna from heaven.
It's a massive tailwind.
The Fed raises rates, ADP's yield goes up, and hundreds of millions in pure profit materialize out of thin air without ADP having to sell a single new software subscription.
Exactly. And of course, the flip side is that when the Fed cuts rates to stimulate the economy, that free profit gets compressed.
That cyclicality is fascinating, but it's also exactly why evaluating this company requires looking past traditional financial metrics, right?
Oh, completely. If you are a classic value investor, like someone who follows Benjamin Graham or Warren Buffett, and you look at ADP's balance sheet for the first time,
Yeah.
you're going to be horrified.
Yeah, I mean, the numbers look terrible on the surface. You pull up their profile, and their price to earnings ratio, the PE, is sitting at 22.3.
Right. And value investors usually want to see a PE closer to, what, 15?
Yeah, exactly. And then you look at their price to book ratio, and it's a massive 15.2.
It's huge.
But maybe the scariest one for just a casual investor is the current ratio, which perpetually sits at around 1.04.
Yeah, let's unpack that, because the current ratio is meant to measure a company's immediate liquidity, right?
Yes.
It simply divides all the cash and assets they can liquidate within a year by all the debts they owe within a year.
Hmm.
So a ratio of 1.04 means they have exactly $1.04 in liquid assets for every $1 of immediate debt.
Which sounds terrible. For a normal manufacturing company, that means you are teetering on the edge of a liquidity crisis. Like if one client pays late, you default on your loans.
Exactly.
So how on earth is a company generating billions in free cash flow sitting on a current ratio that makes them look like they're about to go bankrupt?
It is an accounting illusion. And it's created entirely by that $48 billion float we just discussed.
Wait, really? How does the float break the ratio?
Well, accounting rules dictate that because ADP holds that $48 billion in client funds, they must list it as a short-term asset on their balance sheet.
Okay, that makes sense.
But because every single penny of that money actually belongs to employees and tax authorities and must be paid out imminently, ADP has to list an exact matching $48 billion as a short-term liability.
Let me make sure I'm visualizing this math correctly.
Of course.
If their core business had, say, $2 billion in short-term assets and $1 billion in short-term liabilities, they would have a very healthy current ratio of 2.0. But because they have to add $48 billion to the top of the fraction and $48 billion to the bottom, the ratio gets mathematically dragged all the way down to 1.04.
You nailed it. It completely masks their true corporate liquidity, which is actually incredibly strong.
That is wild.
And just like the float distorts the immediate liquidity picture, their massive profitability distorts their price-to-book ratio.
The 15.2 number?
Yeah. A PB of 15.2 makes the stock look wildly overpriced compared to the actual physical assets the company owns. But the key to understanding ADP is recognizing why their book value, like their net worth on paper, is so incredibly low.
Right, because they don't have to build massive car factories or drill for oil. Their maintenance capital expenditure, the money they have to spend just to keep the lights on and the servers running, is tiny.
It's minuscule.
The report notes it's only about 5.5% of their gross profit, which is easily covered by standard depreciation.
And since they require almost zero capital to grow, and they just generate this river of free cash flow. I mean, in fiscal 2025, they generated $4.84 billion.
So the management team, led by CEO Maria Black, who, by the way, is a 30-year veteran of the company, as she started in sales and worked her way up, she has to decide what to do with that mountain of cash.
Right. And they've raised their dividend for over 50 consecutive years, which is impressive on its own.
It is.
But the real magic is what they do with the rest of the cash.
They aggressively buy back their own stock.
Aggressively.
In January 2026, the board authorized a new $6 billion share repurchase program. And for anyone listening who isn't super familiar with how buybacks affect a balance sheet, it's actually fascinating.
Break it down.
So when a company takes its own cash and uses it to buy its own shares on the open market, it takes cash off the asset side of the balance sheet. Those bought shares are then essentially retired, which reduces the shareholder equity on the other side of the ledger.
So they are intentionally destroying their accounting book value.
Yes.
By doing so, their paper net worth shrinks, which makes that price-to-book ratio look even more bloated. But economically, they're doing something brilliant.
Because they're reducing the total number of slices in the pie.
Exactly. Even if the pie stays the exact same size, your remaining slice continuously increases in intrinsic value.
That explains why their profitability metrics look like typos. I mean, their return on equity routinely exceeds 65%, and their return on invested capital sits around 62%.
Yeah, those numbers are almost unheard of.
It's the ultimate aha moment when you read a financial statement like this. You can't just blindly screen for a low price-to-book ratio. ADP isn't a traditional software company.
Not at all.
It is an asset-light intellectual property royalty stream wrapped around a $48 billion shadow bank masquerading as a boring payroll processor.
That is a perfect summary. The balance sheet looks bad precisely because the business model is so ruthlessly efficient.
Which I guess forces us to look at the other side of the coin.
The risks.
Right. If this business is a perfectly oiled, cash-generating machine with a massive moat, what could possibly disrupt it?
The vulnerability lies in their pricing model.
Yeah.
ADP's revenue is highly variable on a per-seat or per-payslip basis.
Meaning they charge based on the volume of human employees they are processing?
Correct.
And that leads us straight into the structural threat of agentic AI.
Yeah, the big elephant in the room.
We actually saw this play out in the markets in mid-2026. There was some intense volatility, and ADP's stock was pushed down into the 210 to 240 range. Analysts were blaming it specifically on fears over AI and a macroeconomic labor slowing.
They were.
But I have to play devil's advocate here for a second. We've been hearing that the robots are coming for our jobs for 50 years, right?
Sure. Since the ATM?
Exactly.
Yeah.
Every time there's a recession, people panic, hiring slows down, and then a few years later, employment is back to all-time highs. Is the market actually terrified of AI, or is this just temporary noise?
It's a fair question.
Mm-hmm.
But we have to separate cyclical noise from a structural paradigm shift. You are right that a standard recession causing temporary unemployment is cyclical.
Right, and ADP has survived dozens of those.
Exactly. The economy eventually recovers and the jobs come back. But agentic AI represents a fundamentally different threat. We aren't just talking about predictive text or simple chatbots anymore.
We're talking about autonomous agents.
Yes. Advanced systems capable of autonomously executing complex administrative and knowledge work. An agentic AI can, receive an invoice, verify the line items against a contract, email the vendor to resolve a discrepancy, adjust the corporate ledger, and authorize the final payment.
All without a single human clicking approve.
Precisely. So it doesn't just pause hiring during a bad quarter. It permanently deletes the need for that specific seat in the company.
Wow, okay, when you put it like that.
Yeah. If AI permanently automates millions of middle management and administrative tasks, the total addressable market of human employees permanently shrinks.
And for ADP, capital replacing labor isn't just an abstract economic concept. It is a direct, permanent structural headwind to their volume growth.
Because they cannot charge a per payslip fee for an AI agent running on a server in Virginia.
Right. That makes the valuation extremely tricky. How do you even price a stock when its entire revenue model is tethered to a human workforce that might be on the verge of shrinking?
Well, the research report attempts to quantify this by running a discounted cash flow, or DCF, valuation using 3 distinct scenarios.
And for our listeners, a discounted cash flow is essentially a financial time machine. Analysts estimate all the cold, hard cash a company will generate from now until eternity, and then they apply a discount rate to translate all that future money into what it is worth in today's dollars.
Yep, it helps you find the intrinsic value of a stock, regardless of what the market is currently trading at.
So at the time of this report, the market price of ADP was around $242. How did those 3 scenarios shake out?
So in the nominal historical case, the assumption is that ADP can maintain its historical 10% growth rate. If they pull that off, the intrinsic value is calculated at $282.32.
Okay, so that would imply the stock is currently undervalued by the market.
Uh-huh.
But if we factor in some AI headwinds slowing down corporate hiring, what does that middle scenario look like?
The conservative case assumes their growth rate is cut in half, dropping to 5%. In that scenario, the compounding effect slows dramatically, and the intrinsic value drops to $194.98.
That's a big drop, and the absolute worst-case scenario.
The report calls it the no-growth AI risk case. This assumes that AI automation shrinks the workforce so significantly that ADP's free cash flow remains permanently stagnant at its current level of roughly $4.3 billion a year.
Zero growth forever.
Yeah. In that zero-growth scenario, the intrinsic value plummets to $127.25.
Wow. That is an incredibly wide spread. I mean, from 282 down to 127.
It really is.
So if the stock is currently trading at 242, the market is placing a heavy bet on the optimistic scenario.
Definitely. Buying at 242 offers a very limited margin of safety. It requires a fundamental belief that the management team can maintain a 10% growth trajectory.
Which I suppose they could try to achieve by aggressively monetizing their own internal AI tools, or raising prices, or maybe expanding their global footprint in emerging markets.
They could, absolutely.
Yeah.
But they have to do all of that while swimming against the overarching tide of AI potentially reducing aggregate corporate headcount.
It's just fascinating. Looking beneath the surface of ADP teaches you so much about how to actually read a financial statement.
It really is a masterclass in accounting.
Yeah. You learn that a terrible-looking current ratio can actually just be the footprint of a brilliantly executed $48 billion shadow bank.
Right.
And you learn that an inflated price-to-book ratio might just be the sign of an elite capital compounder buying back its own stock.
Exactly.
But it also teaches you that even the most perfectly optimized economic machine is still entirely tethered to the reality of human labor.
That tether is the most critical takeaway from all this. And if we connect this specific corporate risk to the broader macroeconomic picture, it leaves us with a pretty profound societal question.
Oh, what's that?
Well, if agentic AI truly begins replacing a massive swath of the human workforce, it won't just shrink ADP's addressable market. It actually threatens the structural foundation of the global economy.
Because almost everything is built on the back of the human payslip.
Exactly. The entire infrastructure of modern governments, income taxes, Social Security, Medicare, corporate compliance, all of it is designed to extract revenue at the point of human payroll.
Oh, wow. I hadn't thought about that scale.
Right. If corporations increasingly transition from human labor to AI server compute, and those servers aren't paying income tax or contributing to Social Security, how do governments even fund themselves in the future?
That is heavy. When the very plumbing of the economy changes from human wages to server compute, the entire system has to adapt.
It does.
It makes you realize that sometimes when you look at a financial x-ray and the picture looks completely murky, it's not because the machine is broken, it's because you're looking at an entirely different kind of anatomy than you expected.
Well said.
We'll leave you with that to think about. Thanks for joining us for this deep dive into the hidden machinery of the market.